All right, let's talk about a perfect storm for the global economy. We're going to walk through a scenario set in early 2026 where two totally separate crises crash into each other to create what is, frankly, the Federal Reserve's absolute worst nightmare. So let's get into it. And this is really the central question, isn't it? On one hand, you've got the American economy, and it's starting to show some really serious cracks. On the other hand, you have a geopolitical explosion that basically paralyzes the world's energy supply. So when these two things happen at the same time, what breaks first?
The first signs of trouble are actually coming from inside the house. For years, we've heard this story about a permanently resilient U.S. labor market. Well, the data that just came out for February 2026, it just blew that whole narrative to pieces.
And there it is, a headline loss of 92,000 jobs. Now, to give you some context, everybody was expecting a gain of about 59,000. So this isn't just a miss. This is a total shock to the system. It's the worst we've seen since 2020. And it tells us that a kind of structural decay that's been hiding under the surface for months is now right out in the open. But that headline job loss, that's only part of the story. The unemployment rate also ticked up to 4.4%. And even more worrying, the labor force participation rate fell to a 50-month low. So what does that mean? It means people aren't just losing their jobs, they are leaving the workforce entirely. And yet, get this, wages are still growing at 3.8%. So this brings us to this really tricky concept called the wage push paradox. The economy is literally shedding jobs, but the cost to keep the employees you have is still going up. You can see how this creates a massive headache for the Fed, right? They're trying to fight inflation, but one of the main things driving it, wages, just refuses to cool down even while the job market itself is basically freezing over. Okay, so at the exact same moment that the U.S. labor market is cracking, a massive shock hits the global energy supply. We're talking about the world's most critical choke point for oil, the Strait of Hormuz, being completely paralyzed by military conflict. Think about this. About a fifth of the entire world's daily oil supply has to pass through this one narrow waterway. And now, because of military escalation, that flow has slowed to a virtual standstill. This isn't some minor disruption, folks. This is a systemic rupture in the global economy.
And the immediate effect is just chaos in global shipping. You've got maritime insurance companies canceling war risk coverage. The huge carriers like MSC and Maersk have just stopped taking bookings. They're slapping on these massive surcharges and rerouting ships, which adds weeks to transit times. The entire logistics chain is just seizing up.
The impact on price was, well, immediate and explosive. West Texas Intermediate crude futures shot past $111 a barrel. That's the highest level we've seen since mid-2022. It's a full-blown supply-side panic playing out in real time.
But here's what makes this crisis so much more dangerous. It's not just about paying more for oil, it's about whether you can even get it at all. See, producers like Iraq and Kuwait are running out of places to store the oil they can't ship. This leads to what's called the well closure effect, where they're forced to physically shut down production, and that's a process that can take months to reverse. And that's the staggering result. 20 million barrels of oil blocked from reaching the global markets every single day. That is about 1/5 of the entire world's daily consumption, just stuck. So this is it. This is the moment where our two storylines, the weak labor market and the massive oil shock, collide. For the folks at the Federal Reserve, this is the classic stagflationary trap that they had only ever modeled as a worst-case scenario. Well, now it's reality. So look, here is their impossible choice boiled down. Do they cut interest rates to try and save jobs and stop a recession? If they do that, they're basically pouring gasoline on the fire of that energy price spike and letting inflation run wild. Or do they hold rates high to fight that new inflation? If they do that, they risk pushing the already weak economy right off a cliff. There are simply no good options here. And the crazy part is, the Fed knew the labor market was on thin ice before any of this happened. Fed Governor Christopher Waller was already using this pretty stark phrase to describe job growth in 2025. Zero, zip, nada. So that deep concern he had, now it has to deal with an epic inflation shock.
And you better believe the committee is not on the same page. You've got officials like Waller and Stephen Moran arguing you have to just look through the oil spike and cut rates to save jobs. They see the price surge as just a tax on consumers. But then you have others, like San Francisco Fed President Mary Daly, who are way more cautious. She's saying that both of the Fed's mandates, jobs and price stability, are now at risk. And the result of all this disagreement? Policy paralysis.
So if the Fed is trapped, what in the world does that mean for the rest of us? Let's shift gears and talk about the new playbook for corporations and investors who are just trying to get through this incredibly volatile time. For investors, a lot of the old strategies are just broken. The new playbook really revolves around two critical moves. You have to actively hedge against this new inflation, and you have to completely rethink the role that bonds play in your portfolio. First up, hedging. In a world of these massive supply-driven price shocks, real assets are king. The advice is to overweight physical commodities. We're talking energy, metals. And the proof is right there in the numbers. While stock markets are getting hammered, broad commodity ETFs have been posting gains of 5, 7, even 8% in a single week. They offer a direct shield against this kind of inflation. Second, let's talk bonds. With inflation risk roaring back, long-term bonds become really dangerous. So the focus is shifting to what's called zero-duration debt. These are things like floating rate loans, where the interest payments actually adjust with short-term rates. They give you income without that huge risk of getting wiped out if the Fed has to keep rates higher for way longer than anyone expects. If we zoom out, this crisis isn't just some temporary shock. It's speeding up a really fundamental change in the global economy. The era of seamless globalization is giving way to a new world defined by fragmentation. We're moving from a focus on efficiency to a focus on security, and from low cost to resilience. Which leaves all of us with a final and pretty provocative thought. We are entering a new era that's going to be defined by conflict, by bottlenecks, and by the need to protect access to critical resources. And in a world like that, we have to ask ourselves, have we reached a point where guaranteeing security is actually more valuable than pursuing growth?